What if everything you thought you knew about money was a lie? What if the soaring national debt, the inflation that eats your paycheck, and the economic uncertainty that keeps you awake at night weren't accidents but meticulously engineered by a hidden financial machine so complex even the smartest economists can't fully see it? You've been told that debt is just numbers, that governments borrow responsibly, and that crises are rare hiccups in an otherwise stable system. But here's the truth. The richest nations in the world, America, Japan, Germany, the UK, aren't just afraid of debt. They fear their own debt because it is no longer theirs to control. It is bound, tangled, and weaponized inside a shadowy web of financial instruments so vast, so opaque, that a single misstep could trigger collapses faster than you can say, bailout. Every time you swipe your card, every mortgage payment you make, and every government bond purchased, you are indirectly playing into a system built to profit the invisible architects at the top and punish everyone else. That safety you feel in your bank account? Illusion? The stability of your economy? Engineered. Where are you watching from right now? Drop a comment. Want to see how global this really hits? And if you want the unfiltered truth behind the numbers, subscribe. We're peeling back the layers that mainstream finance refuses to show you. Because here's the secret. They don't. Broadcast on the evening news. Debt in the richest nations, isn't just growing it. Growing inside a trap you can't escape, where every dollar borrowed today is a dollar chained to a shadow bet someone else made. And if you think rising interest rates or a stock market dip is the danger, think again. The real threat is invisible, and it's already reshaping the rules of money itself. Debt has always been political. Let's rewind to the 18th century. When Britain was funding global wars, the Crown didn't just raise taxes, it issued bonds to fund military campaigns. Citizens bought these bonds believing in national stability. Yet, behind the scenes, financiers were creating hidden layers of risk, swapping bonds, hedging bets, and inflating profits from other people's debts. Fast forward a few centuries, and the pattern repeats, almost like a blueprint. The United States in the 1980s, Japan in the 1990s, Europe post-2008. The past echoes into the present, because governments, just like empires, relied not only on visible debt but on invisible mechanisms, swaps, and shadow banking structures. These were originally promoted as hedges, ways to protect economies, but a variation of history repeats itself every single time. A system designed to safeguard ends up feeding systemic risk. Take the Latin American debt crisis of the 1980s. Countries like Mexico and Brazil borrowed heavily, thinking they were investing in infrastructure, but their loans were intertwined with complex swaps and derivative contracts, creating hidden obligations they didn't fully understand. The result, a cascade of defaults, inflation, and years of austerity. That moment, strange as it seems, is not just a relic of history, it is a variation of what you see today in the U.S. Federal Reserve's balance sheet, where trillions of derivatives quietly tether government debt to global financial markets. Even the 2008 crisis is a mirror. Banks created mortgage-backed securities, packaging debt like commodities. On the surface, it was just housing finance. But underneath, a variation of the same pattern: shadow contracts, bets on bets, and opaque risk was strangling the economy. Millions lost homes, yet the institutions responsible were bailed out, continuing the cycle. History repeats itself because the mechanism, while cloaked in different forms, always produces the same winners and losers. So, when you look at national debt today, understand this. What you see bonds, loans, deficits is only the tip of the iceberg. The real leverage and danger are hidden, and they are growing faster than any historical precedent. The past and present are linked in more ways than textbooks admit, and this variation of history is happening now, in plain sight. Here's where most people's understanding of debt completely fails. Governments talk openly about borrowing, deficits, and interest payments. Economists debate austerity versus stimulus, but there is a hidden decision made decades ago that no headline covers. The choice to offload national risk into a derivatives and shadow banking web so opaque, even central bankers admit they cannot fully measure it. This web is the ultimate financial It began quietly after World War II. As nations rebuilt, the US and UK, leveraging their economic dominance, began allowing private banks and shadow institutions to create contracts that would bet on interest rates, currency fluctuations, and sovereign defaults. At first, these were small, discrete trades, but soon they multiplied into trillions. By the 1980s, the system was already too big to manage, yet it was marketed as financial innovation, a phrase designed to mask parasitic risk and moral hazard. What's shocking is that the architects of this system didn't just act alone. Governments, regulators, and central banks, directly or indirectly, incentivized this network because it allowed borrowing on unprecedented scales without immediate political blowback. Suddenly, a nation could borrow $1 trillion in bonds, yet through swaps and derivative bets, the real obligation could be $10 trillion or more completely off balance sheet. This was the ultimate leverage. Debt multiplied invisibly, creating an illusion of stability while ensuring long-term vulnerability. Consider Japan after the 1990 bubble. Banks were sitting on trillions in bad debt, but used derivatives to hide the true size of their liabilities. The public saw only mild corrections. The real damage was quietly engineered, compounding over decades. Or the European Central Bank during the 2010 sovereign debt crisis. Greece, Italy, Portugal, they weren't merely in trouble because of government overspending. They were trapped in derivative chains linking their debt to global markets, a variation of the same historic trap repeated across centuries. And here's the kicker. The architects of this system have names, but you won't find them on government websites. Some are bankers, some are hedge fund moguls, and some are quietly employed at regulatory bodies. Their decisions, hidden in legal contracts no average citizen can read, dictate whether a nation collapses or survives. The moral hazard is staggering. The system is designed so that the profits are privatized while losses are socialized. But here's the cliffhanger. There's one entity, one web, one financial hub that controls the majority of these derivative chains, and the receipt is wilder than you think. This is the heart of the system, the part designed to make your head spin, because understanding it fully reveals why national debt is not just a number, it's a cage. At the center is derivatives financial contracts whose value derives from another asset. Bonds, loans, interest rates, currencies, or even entire indices. Imagine a bet where you don't just bet on a horse race, but on every horse race in the world, and then bet on the bets themselves. That's derivatives in a nutshell. Now layer shadow banking on top, entities that operate like banks but without regulatory oversight. Hedge funds, special purpose vehicles, conduits, and off-balance sheet vehicles all move trillions daily, often betting against the very bonds governments issue. By 2020, estimates place the global derivatives market at over $600 trillion in notional value, compared to the world GDP of $95 trillion. That is, more than 6 times the economic output of the entire planet tied to bets we don't fully understand. Take interest rate swaps. Governments borrow at fixed rates, but can enter into swaps to pay floating rates. On paper, this looks like risk management. But if hundreds of institutions bet against those rates at once, the domino effect can trigger cascading collapses, forcing central banks to intervene with emergency liquidity. In 1998, the collapse of long-term capital management, a hedge fund, with $1.25 trillion in derivative exposure, almost toppled the global financial system, requiring a secret bailout orchestrated by the Federal Reserve. Or consider credit default swaps, CDS, essentially insurance on debt. A country like Greece could sell CDS on its bonds to hedge risk, but global banks could buy CDS as speculative instruments. By 2008, the notional CDS market had ballooned to $62 trillion, meaning far more was insured than actually existed. When Lehman Brothers failed, The chain reaction risked $1 trillion in immediate global financial exposure, requiring emergency measures to prevent economic meltdown. The moral hazard here is staggering. Institutions can take massive risks, knowing the downside is socialized, not privatized. Every default, every rate hike, every recession becomes an opportunity for insiders, while ordinary citizens feel the pain: job losses, inflation, foreclosures. Even modern examples show this system is evolving faster than ever. In 2022, the Bank for International Settlements reported that global derivatives exposure exceeded $640 trillion, and the shadow banking system now handles over $70 trillion in assets, largely invisible to regulators. The richest nations are no longer simply in debt. They are entangled in self-reinforcing webs that guarantee recurring crises. Analogies help. Imagine a spider web spun across continents, invisible to the naked eye, with a fly trapped at every intersection. Governments, banks, and citizens are the flies, moving money, issuing bonds, and trading securities, all unaware that the web is engineered to redistribute risk upward. The spiders, private institutions, hedge funds, and shadow banking entities. Their greed fuels the system. Their control ensures permanence. Some shocking numbers to anchor the stakes. $600 trillion global derivatives. Notional value versus $95 trillion global GDP. $1.25 trillion LTCM exposure in 1998, nearly collapsing global markets. $62 trillion CDs market size in 2008, exceeding actual insured debt. $70 trillion shadow banking assets globally, mostly unregulated. DSX Libera. The multiplier effect that off-balance sheet derivative contracts can impose on national debt. And yet, public narratives remain. Debt is manageable. Economies are resilient. The real story. These numbers don't lie. The system is parasitic, self-feeding, and designed to amplify, turning every financial event into profit for a few and catastrophe for the rest. Here's the truth they hope you never consider. The next crisis will be faster, more global, and more destructive than anything in history. The web of derivatives is far larger, far faster, and far more interconnected. What once took months to trigger a crisis can now cascade in hours or days, touching every market, currency, and bank on the planet. Denial is the deadliest weapon. Nations act as if debt is just a number, as if bonds can betray them, as if derivatives are harmless hedges. Yet every choice rate hikes, bond purchases, bailouts interacts with this hidden system, creating feedback loops that guarantee repeated collapse. Borrowed time is not an abstraction. It's a framework. And the richest nations are not immune. They are the most trapped. So, where does that leave us? It leaves us questioning the institutions we've trusted, the markets we participate in, and the myths of stability fed to us through financial headlines. Are we complicit by ignorance? Are we powerless observers in a system we unknowingly feed? Or can awareness shift the trajectory, even just enough to demand transparency and accountability? Share your skepticism below. Tell the world you see the strings. Subscribe to join a community committed to understanding the hidden architecture of debt, the shadows behind the headlines, and the urgency of a system teetering on engineered collapse. Because ultimately, the lesson is clear. Debt is not just a financial instrument. It is a trap designed to endure, a shadow system that immortalizes cycles of inequality, risk, and collapse. The question now is not whether history will repeat, but whether we recognize the pattern in time to change course. Are we wiser now, or walking the same path in better suits?